Forget all the talk about a Bitcoin dip. Forget the analysts drawing lines on a chart pointing down to 70 or even $60,000. Right now, the loudest story in the market is also the most dangerous one you can listen to. These folks are playing by a rule book that has expired. They're trying to navigate the road ahead by staring in the rearview mirror. And trust me, acting on this old, outdated information could be the single most expensive mistake you make this cycle. Because while they're bracing for a crash, they're missing the bigger picture entirely. My research, the on-chain data, and the huge shifts happening in the global financial system all point to a completely different reality. A reality where a massive surge to $200,000 per Bitcoin isn't just possible, but is the most likely data-driven outcome by 2026. In this video, I'm going to break down the three most overlooked signals that the mainstream consensus is completely ignoring. I'll show the strategy I'm personally using to capitalize on what I believe is the single greatest wealth creation opportunity of our generation. So stick with me, because what I'm about to show you goes way beyond a simple price prediction. This is about understanding a fundamental paradigm shift that's happening right now, right under our noses. First, let's talk about the elephant in the room. Turn on any financial news channel, scroll through social media, and you'll be hit with a wave of cautious, if not downright bearish sentiment. We've had a tremendous run, and the common thinking is that a deep, painful correction is not just likely, but overdue. You'll hear analysts talking about the end of the classic 4-year cycle. For years, this theory, tied to Bitcoin's halving events, has been the go-to model for predicting market tops and bottoms. It suggests that about 12 to 18 months after a halving, Bitcoin peaks, and then a long bear market follows. Since the last halving was in April 2024, this old playbook screams that the top is either already in or is coming very soon in early 2025 with a plunge right after. They'll point to historical charts showing the familiar patterns of 2013, 2017, and 2021. They'll talk about macroeconomic headwinds, persistent inflation, the risk of global recession. Some institutional investors are even pricing in a high chance of a big market correction in the next year. Predictions based on these old models put Bitcoin somewhere between $80,000 and $100,000, with some even calling for a drop back to the last cycle's highs around $70,000. And let's be fair, this caution isn't coming out of nowhere. It's born from the scars of previous bear markets. The fear of buying the top and riding it all the way down is a very real concern for any seasoned investor. And the crypto world is famous for its volatility and its brutal corrections, which have historically wiped out 80% or more of Bitcoin's value from its peak. Following the herd, taking some profits, and getting ready for winter seems like the safe, smart thing to do. It's what worked before. But that's the key phrase. Why before? The entire argument from the bears rests on one single massive assumption, that this cycle will play out just like the last ones. They're assuming the players are the same, the rules are the same, and the environment is the same. And that right there is a monumental error in judgment. They're mistaking the echoes of the past for a map of the future. Following this illusion, and this siren song of outdated cycle theory, will likely cause investors to sell way too early, missing the most explosive part of this bull market. They're getting ready for a drizzle, completely unaware that a tsunami of capital is building just over the horizon. The market's very structure has been rewritten, and the old rule book just doesn't apply anymore. So here's my core thesis. As clear as I can make it, the historical 4-year Bitcoin cycle isn't just getting longer. It's being fundamentally broken and reshaped by a new permanent force on the demand side of the equation. The next peak will be higher and will likely show up later than most people expect. My price target of $200,000 by the end of 2026 isn't a sensationalist guess. It's a forecast based on a sober analysis of verifiable data. Some analysts see a potential for Bitcoin to hit between $170,000 and $200,000 in this time frame, and the data I'm seeing supports this bullish case. This entire argument stands on three powerful pillars, three tectonic shifts in the market that, when you put them together, create a powerful multi-stage rocket for Bitcoin's price. First, the Great Wall of Money. We are witnessing an unprecedented and permanent change in the demand for Bitcoin, driven by institutional adoption on a scale that makes everything before it look tiny. This isn't just about a few companies buying Bitcoin anymore. It's about the very plumbing of the global financial system connecting directly to the Bitcoin network. Second, the on-chain proof. The data being written onto the Bitcoin blockchain itself is telling a story of a market that is far from overheated. Metrics that have reliably signaled cycle tops in the past are showing we are still in the middle of the bull run, not at the end. The conviction of long-term holders and the underlying valuation models suggest there is a ton of room to grow. And third, the macroeconomic tailwind. While many fear economic headwinds, a combination of factors including global liquidity dynamics and growing regulatory clarity is creating a perfect environment for hard assets like Bitcoin to flourish over the next 18 to 24 months. These three signals aren't separate. They're interconnected, creating a feedback loop that will, in my opinion, propel Bitcoin to heights that will shock the mainstream analysts who are still looking at the charts from 2017. So let's break them down one by one, starting with the most powerful force of all, the institutionalization of Bitcoin. For years, we talked about institutional adoption as something that was coming soon. Well, in 2025, it's not a theory anymore, it's a reality, and its scale is just breathtaking. The market has fundamentally shifted from being driven by retail speculation to being led by institutional accumulation. This isn't a slow evolution. It's a revolution in who is buying Bitcoin and why. The most powerful engine of this revolution is, without a doubt, the spot Bitcoin ETFs. The approval of these products in the United States wasn't just another news story. It was a landmark event that opened a regulated, insured, and incredibly simple gateway for the largest pools of capital in the world to get exposure to Bitcoin. We're talking about trillions of dollars in retirement accounts, pension funds, and asset managers that were previously locked out of this market. Now that capital has a direct pipeline, and the numbers are staggering. On many days, the net inflows into these ETFs have dwarfed the new supply of Bitcoin being created by miners. After the halving in April 2024, only about 450 new Bitcoin are mined each day. Yet, we've seen days where ETF inflows represent demand for thousands of Bitcoin. While flows can be volatile, the cumulative net inflow since their launch has already reached tens of billions of dollars, with some estimates putting it in the $20 to $25 billion range as of mid-November 2025. This creates a massive supply shock. It's simple economics. When demand consistently outstrips new supply, the price has only one way to go. This isn't speculative retail FOMO. This is steady, programmatic buying by some of the biggest financial names on the planet like BlackRock and Fidelity. But the ETFs are just the most visible part of this story. The second layer is corporate and even sovereign adoption. We've moved far beyond just MicroStrategy. Now, a whole range of public companies are adding Bitcoin to their balance sheets as a treasury reserve asset. Just look at what Metaplanet, a publicly traded company in Japan, has been doing. They've been aggressively buying Bitcoin, even issuing bonds specifically to raise money for more purchases. In late 2025, they announced a major plan to issue new shares to raise capital, with a big chunk of it earmarked for more Bitcoin. This is a sophisticated strategy that shows a deep conviction in Bitcoin as a long-term store of value, especially with economic pressures like a weakening yen. This creates a powerful game theory situation. As more companies adopt a Bitcoin standard for their treasury, it puts pressure on their competitors to do the same just to protect their own purchasing power. And this trend is expanding to the highest levels. We're hearing credible discussions about sovereign wealth funds, the multi-trillion-dollar investment arms of nations, starting to add Bitcoin to their reserves. While many reports are still speculative, the fact that these conversations are happening at all is a game changer. When a handful of these funds make even a tiny 1% to 3% allocation, it could unleash trillions of dollars in new price-insensitive demand on a scale the Bitcoin market has never seen. Finally, none of this would be possible without the quiet behind-the-scenes work of building institutional-grade market infrastructure. The big barrier for institutions used to be security and compliance. That barrier is gone. We now have regulated custodians, sophisticated derivatives markets, and advanced analytics platforms. The recent completion of the first ever public third-party security audit of Bitcoin Core in late 2025 is another huge step. The audit, done by cybersecurity firm QuarksLab and funded by groups like Brink, found no critical high or medium severity vulnerabilities in the software that secures the entire network. And this kind of rigorous independent validation provides enormous assurance for large conservative capital allocators. It transforms Bitcoin from a speculative tech asset into a mature, auditable, and investable global monetary network. When you combine these three layers, the fire hose of ETF demand, the game theory of corporate and sovereign adoption, and the solid foundation of mature infrastructure, you get a demand picture that looks nothing like previous cycles. The buy side is now dominated by players with deep pockets, long-time horizons, and strategic reasons for buying. They are soaking up the limited supply, and they aren't planning to sell. This is the Great Wall of Money, and it's the first reason why $200,000 is a realistic target. If institutional demand is the fuel for the rocket, then the on-chain data is our dashboard, telling us exactly where we are in our journey. And right now, even with the price pushing towards new highs, the dashboard shows we are nowhere near our final destination. This brings me to my second key signal, the clear on-chain evidence that the cycle is getting longer. The theory of lengthening cycles suggests that as Bitcoin's market cap grows, it takes way more capital and more time to move the price, causing each bull market to last longer than the one before it. The 4-year cycle is a powerful story, but the data shows it's an oversimplification. Each cycle has been longer than the last, and this one looks to be no different. The herd is setting their watches for a 2025 peak, but the blockchain itself is telling us to be more patient. Let's look at one of the most reliable on-chain indicators out there, the MVRV Z-Score. Simply put, the MVRV Z-Score measures if Bitcoin is overvalued or undervalued relative to its fair value. Historically, when the MVRV Z-Score enters the upper red box above a value of 6 or 7, it signals a cycle top, a period of extreme euphoria. So where are we today in late 2025? Even with Bitcoin's price challenging all-time highs, the MVRV Z-Score is hovering around the 1.25 to 1.69 range. This is a healthy mid-bull run level, nowhere near the red mania zone. In past cycles, this is the level we saw before the final explosive ascent, not at the peak. For the score to reach that historical top zone, Bitcoin's price would need to go up substantially from here. The data is screaming that the market isn't yet euphoric and isn't at its peak. The second piece of on-chain evidence comes from the behavior of the most committed Bitcoiners and the long-term holders. We can measure the supply held by addresses that haven't moved their coins for at least 155 days. This is the smart money. When the long-term holder supply is high, it acts as a powerful price support because it means less Bitcoin is available on the market to be sold. In previous cycle tops, we saw a clear pattern. As the price went parabolic, long-term holders would start selling their coins to take profits. We'd see a sharp drop in their supply. Today, we're seeing some profit taking, which is normal. However, we are not seeing the kind of mass selling that signaled past tops. A huge portion of the supply remains in the hands of strong believers. Recent data even shows that large whale wallets have been actively accumulating during recent dips, absorbing the supply sold by smaller, nervous hands. This transfer of coins from weak hands to strong hands is a classic bull market sign and reinforces the idea that the sellable supply is continuing to shrink. These on-chain metrics, and many others like them, paint a consistent picture. They show a market that is maturing, a cycle that is extending, and a holder base that remains strong. While the price on your screen might seem high, the underlying metrics of the network suggest we are still in the middle stages of the bull run, with the most dramatic phase still to come. The blockchain doesn't lie, and it's telling us the peak is further and higher than the old playbook suggests. The third and final signal is the evolving macroeconomic landscape. While many see macro as a headwind, I believe that over the next 18 months, it will turn into a powerful tailwind, pushing capital towards hard, scarce assets like Bitcoin. The first part of this is global liquidity. While the frantic money printing of 2020 and 2021 is over, we can't underestimate the sheer amount of capital that was pumped into the system. The global M2 money supply is estimated to be around $123 trillion as of the third quarter of 2025. That massive pool of money hasn't just disappeared. It's sloshing around the financial system, looking for a home where its purchasing power won't get eaten away by inflation. On top of that, we're starting to see signs that central banks might be forced to pivot back towards easier policies as we head into 2026. If economic growth slows down or debt costs become too high, the pressure to lower interest rates will be immense. Some analysts are already forecasting potential rate cuts in the coming year, which is historically rocket fuel for assets like Bitcoin. A related factor is the path of the US dollar measured by the DXY index. As of late 2025, the dollar is strong, trading near recent highs. However, many major banks expect the DXY to soften and trend downwards into 2026. Bitcoin has a historically inverse correlation with the dollar. A weakening dollar means it takes more dollars to buy one Bitcoin, pushing its price up. A gradual decline in the dollar's strength throughout 2026 would provide a constant, gentle push at Bitcoin's back. Finally, there's the tailwind of regulatory clarity. For years, the lack of clear rules held back institutions. That's changing fast. The approval of spot Bitcoin ETFs was a huge step, but it's part of a broader trend. We're seeing real legislative efforts like the Financial Innovation and Technology for the 21st Century Act, FIT21, in the US, that aim to create a clear framework for digital assets. This regulatory clarity is the final piece of the puzzle for many institutions, transforming Bitcoin from a Wild West asset into a legitimate part of the global financial system. It removes career risk for portfolio managers and gives them the green light they need to make multi-billion-dollar allocations. When you put these macro pieces together, the ocean of existing liquidity, the potential for new central bank easing, a weakening dollar, and a solidifying regulatory foundation, you get a powerful macroeconomic tailwind. This isn't just a light breeze, it's a structural shift that favors a digitally native, globally accessible, perfectly scarce, and provably secure store of value. It's the perfect storm for Bitcoin. Now, before I go any further, let me be crystal clear. What I'm about to share is absolutely not financial advice. This is for educational purposes only. I'm just giving you a transparent look at how I'm personally navigating this market based on my own research. You should always do your own research and make decisions based on your own financial situation and risk tolerance. With that said, my strategy is based on one core belief: waiting for a huge dip to the $70,000 or $80,000 levels that many are calling for is a fool's game. That dip may never come, and if it does, it will likely be a brief, violent wick down that's almost impossible to catch. Trying to time the exact bottom is a losing game. So my approach is to systematically build a position over time. I'm using a dollar cost averaging DCA strategy, but with a tiered approach based on key support levels. Here's how I am personally deploying capital. First, I have been establishing a core position as Bitcoin consolidates below the key $100,000 level in the $90,000 to $98,000 range. This ensures I have skin in the game and won't be left behind if the price begins its next major leg up without a deep pullback. Second, I'm holding capital in reserve to deploy on a moderate correction. My next major buy zone is in the $85,000 to $90,000 support area. This is a level that has shown strong support, and a pullback to this zone would, in my opinion, represent a healthy consolidation. Finally, I have a third, smaller tranche of capital I call my opportunistic allocation. I'm saving this for the unlikely but not impossible scenario of a deeper fear-driven sell-off. My target for this capital is the $75,000 to $80,000 range. A chance to buy at that level would be an exceptional opportunity that I want to be prepared for. My mindset for this entire position is a long-term hold. My time horizon is 12 to 24 months, targeting what I believe will be the cycle peak in 2026. My conviction isn't based on hope, but on the three fundamental signals we've just discussed: relentless institutional demand, bullish on-chain data, and a supportive macro environment. This is my plan to build a position methodically and without emotion. By the way, if you're finding this data-driven approach valuable and want to see how these metrics and my thesis evolve, do me a huge favor and hit that subscribe button and turn on notifications. I'll be tracking these signals every step of the way on our journey to $200,000 and beyond. It's free, and it means you won't miss a single update. Now, having a plan to get in is only half the battle. You absolutely must have a plan to get out. Let's talk about that. Again, this is not financial advice, but a framework for how I'm thinking about taking profits. This is maybe the most important part of any investment strategy, and it's the one most people forget. Getting rich on paper during a bull run is easy. The hard part is turning that into real life-changing gains. Crypto history is full of stories of people who rode the wave all the way up, only to ride it all the way back down because they were blinded by greed and had no exit plan. My exit strategy is designed to be systematic and unemotional. I will not try to sell the exact top. That's a fool's game, just like trying to buy the bottom. Instead, I'll be scaling out of my position in tiers as the price hits my targets. My personal plan, based on my analysis, looks something like this. Tier 1 at $130,000. Once Bitcoin breaks and holds above $130,000, I plan to sell about 25% of my total position. This is huge because it takes my initial capital off the table. At this point, the rest of my position is effectively playing with house money. This immediately de-risks my entire investment and lets me view the rest of the bull run with a clear head. Tier 2 at $150,000. As the price climbs and hits the $150,000 mark, I plan to sell another 25% of my original position. This is where I start locking in significant life-changing profits. It's not about being greedy, it's about systematically cashing in on the gains. Tier 3 at $170,000 to $180,000. In this price range, which aligns with the price targets of some bullish analysts, I'll sell another 25%. The profits here become substantial. The final tier, the moon bag. The last 25% of my original position is my free ride. Having taken major profits at 3 separate points, this is the part I can hold with zero emotional attachment. I can let this portion ride to see if Bitcoin does hit $200,000 or even higher. If it goes to $250,000, fantastic. If the market tops and pulls back 50%, it doesn't matter because I've already secured my main profits. This tiered exit strategy is my defense against fear and greed, the two emotions that destroy investors. So let's put it all together. We are at a unique moment in Bitcoin's history. The bears and the skeptics are looking at the shadows of the past, using an old map for a new world. They see the price knocking on the door of 6 figures and they feel fear. They see the end of a cycle, but when you look at the data, when you look at the fundamental drivers, you see a completely different picture. You see the beginning of a new era. You see signal number 1, the great wall of institutional money, a permanent structural demand from ETFs, corporations, and soon sovereign nations, creating a supply shock that makes previous cycles look like a dress rehearsal. You see signal number 2, the on-chain proof. Data from the blockchain itself, like the MVRV Z-Score, tells us we are not at a euphoric peak, but in the healthy, powerful middle of a lengthening bull market. And you see signal number 3, the macroeconomic tailwind, a global environment of vast liquidity and growing regulatory clarity that is creating the perfect storm for a scarce digital non-sovereign store of value to flourish. These 3 signals working together aren't just pointing to a higher price. They are signaling a fundamental re-rating of Bitcoin as a global monetary asset. A $200,000 Bitcoin by 2026 isn't a wild guess. It's a data-driven forecast based on these powerful, undeniable shifts. While the herd is bracing for a dip, the data is telling us to prepare for a surge. The biggest risk right now is not volatility, it's being on the sidelines. The greatest opportunity of this cycle is still directly in front of us. Now I want to hear from you. What do you think? Is my $200,000 target too aggressive? Or maybe is it too conservative? Let me know your price target for 2026 in the comment section below. I read every single one. And if you want to join me in this community as we track this thesis all the way to the top, make sure you are subscribed to the channel with the notification bell turned on. Thanks for watching. I'll see you in the next one.